All right, let's dive right into this explainer and explore a really fascinating new mathematical approach to a literal trillion-dollar question. Today, we are looking at a recent paper by researcher Igor Halperin called Are Three Matrices All You Need to Beat the Market? It explores this radically simplified approach to dynamic portfolio management. We're talking about stripping away all the complex black box AI and going straight back to elegant, rigorous mathematics.
So, can you consistently beat the stock market without some magic crystal ball or a supercomputer running complex AI? Well, for decades, classical finance theory, specifically the efficient market hypothesis, has basically told us that systematically beating the market over a period of years is just impossible. The theory claims that current prices already reflect all valuable information, meaning any outperformance you might see is honestly just luck. But today, we're looking at research that mathematically challenges that very assumption, proposing a system that uses strictly historical market data to genuinely find a persistent edge.
Now, you might actually recognize the phrasing here. Inspired by Google's famous Attention is All You Need AI paper, this researcher is literally claiming you absolutely do not need a massive, power-hungry neural network. Instead, a parsimonious three-matrix model, which he calls the OMD portfolio, is totally enough to represent the entire stock market system and make market-beating trading decisions. So here's our roadmap for today. First up, beating the efficient market. Second, the three magic matrices. Third, ranking risk and return. Fourth, the arrow of time. Fifth, testing the strategy. And finally, number 6, beating the market. Let's get right into it. Section 1, beating the efficient market. We have to start with the Goliath of the industry, traditional finance theory and the massive institutions that rely on it. The crucial point you need to know here is that classical methods, like Markowitz mean variance optimization, really struggle with fragile math. I mean, they require you to forecast expected returns, which is incredibly difficult on its own, and they rely on these wildly complex covariance matrix inversions. The problem is, when you invert a massive matrix of stock correlations, even tiny estimation errors get amplified, making the whole portfolio incredibly fragile. The OMD portfolio completely bypasses this. It uses basic, everyday data, just prices, volume, and market caps, to build robust cross-sectional ranks. There are no fragile matrix inversions, no black box predictions. It's a mathematically sturdy approach that keeps a tiny data error from blowing up your retirement fund. Moving on to Section 2, the three magic matrices.
What's really wild here is how this model completely strips away the usual complexity of modern quantitative trading and relies entirely on exactly 3 straightforward mathematical objects. First up is the distance matrix. Think of this kind of like a constellation mapping out stock movements. It calculates the correlation between stocks and translates it into a geometric distance. So highly correlated stocks sit really close together, while negatively correlated ones sit far apart. Then, the second and third matrices are Markov chains that take all the stocks in the S&P 500 and rank them into deciles based on their trailing return, so performance, and their trailing volatility, which represents risk.
All right, Section 3, ranking risk and return. To really get how these ranking matrices function as a trading strategy, we have to look at the math powering them. Both the return and volatility rankings are modeled as Markov chains. So instead of trying to guess exactly what a stock's exact price will be tomorrow, which is a bit like guessing exactly how fast a car is driving in absolute terms, these Markov chains just calculate the probability that a stock will pass the peer right in front of it. It's a purely relative ranking system. It groups stocks into 10 buckets, or deciles, and then just tracks the probability of a stock transitioning from one bucket to another over time. Take a look at how these transition probabilities actually play out visually over time. On the far left at the one-day horizon, you're going to see a bright, highly diagonal line for both return and volatility. This means short-term transitions of just one day are highly predictable. Stocks tend to stay in their current decile bucket from Monday to Tuesday. But by the time we look at the direct one-month matrix in the third column, the top heat map representing returns has become this completely dispersed dark purple blur. The memory of the rank is totally gone. It's almost entirely random. But look at the bottom heat map representing volatility at 1 month. It still has those bright glowing corners, meaning the calmest stocks tend to stay calm and the most volatile stocks tend to stay volatile. And that visual difference, that hits on a fundamental finding in this research. There's a fascinating split between risk and return. Predicting exactly how much a stock will return relative to its peers over a month is incredibly difficult. The return chain is mostly unforecastable. But the volatility chain is highly forecastable, simply because market volatility clusters over time. Knowing this allows the OMD portfolio to weight its selection scores appropriately, relying heavily on those predictable risk rankings to carve out its edge. Which brings us to Section 4, the arrow of time. Now, this brings up a pretty critical problem. If the system is completely relative and market neutral, how does this model know when the entire market is crashing? Because think about it. If every single stock drops 10%, their relative rank to one another stays exactly the same. To solve this, the researcher built a second set of chains using fixed absolute thresholds, creating a regime-aware system. Look at the flat orange line right here. That is the standard market-neutral rank, completely blind to overall conditions. But then look at the blue line. That represents the regime-aware chain. By measuring stock returns against fixed historical thresholds rather than just against peers, the blue line dynamically swings with the broader market. You can clearly see it absolutely plummeting during major crises like the 2008 financial collapse and the 2020 COVID crash. This proves the model can mathematically identify market regimes using nothing but internal price data. It gets kind of mind-blowing here, because being able to see these transitions allows the model to measure something physicists call entropy production. In this context, it represents the arrow of time. The model tests different firm characteristics like size, beta, or momentum to see if they possess an arrow of time that points forward. By calculating entropy, the math actively separates true leading indicators that actually drive future stock rankings from lagging noise that merely echoes past performance. I know, borrowing physics concepts to beat the stock market sounds a bit crazy, but the math proves that trailing momentum is largely a follower, while a stock's fundamental volatility is a true leader of future rank. Okay, Section 5, testing the strategy. So, it's one thing to have elegant math on a whiteboard. It's another entirely to deploy it into the messy reality of the stock market. The researchers set up an incredibly rigorous simulation for this. The universe is the S&P 500. The strategy uses an adaptive blended portfolio, combining a long-only sleeve with a protective, market-neutral long-short sleeve. Crucially, the test incorporates a strict 5 basis point transaction cost every single time a stop is traded, perfectly simulating real-world slippage and fees. And most importantly, the model was tested strictly on out-of-sample data. It was tuned on data up to 2021 and then let loose on unseen future data, which included the brutal 2022 bear market and a completely fresh dataset spanning all the way into 2026. And finally, Section 6, beating the market. The stage is set. Let's see if these matrices actually worked out in the wild. A major hurdle for quantitative strategies is always that trading costs eat all the profits. Well, this clearly shows how the OMD portfolio solves that using a concept called hysteresis, or a no-trade band. Look at the gray line. That shows the strategy's return if it rebalances completely every month to hold the absolute best-ranked stocks. The turnover is massive, the transaction costs pile up, and the performance totally drags. But then check out the red line, which introduces a simple rule. Only swap out a stock you currently hold if a new challenger beats it by a specific mathematical tolerance. This no-trade band slashes portfolio turnover by more than half. And as you can see, the red line beautifully outpaces the gray, proving that limiting expensive portfolio turnover is absolutely key to making this out-of-sample success actually tradable. So, what's the final verdict here? In the completely clean, out-of-sample test window spanning from January 2025 to July 2026, which is a dataset the model had never seen during its design phase, the diversified OMD portfolio achieved a remarkable Sharpe ratio of 1.32. To put that in perspective, it utterly crushed the broader market index, which sat at a Sharpe of 1.14. It generated an annualized return of 56% compared to the market's 20%. And remember, that's all while being marked to market daily and paying those realistic transaction costs. Which leaves us with a pretty massive, thought-provoking question, right? We've just seen that without massive AI data centers, without complex matrix inversions, and without subjective fundamental analysis, a purely mathematical system reading basic price data can actually find a persistent edge. If 3 elegant matrices can consistently outsmart the S&P 500, what does that mean for the future of finance and the long-held myth of the perfectly efficient market? Perhaps the market isn't perfectly efficient after all. Maybe we just needed a better way to measure the flow of time and risk.